Welcome to your presentation for basic income statement analysis using vertical analysis, or as we refer to it, common size analysis. So what is vertical analysis or common size analysis? We're really comparing all items on the income statement for when we're completing this analysis to total revenues using percentages. Because we're always comparing it to total revenue will always be at a value of 100%. Individual sources of revenue and the operations expenses are expressed as a fraction of total revenues, but as a percentage. Each percentage computed is a percent of a common number. That's why we refer to it as common size analysis. Total revenue is that common number that we're comparing everything to. UCLE recommends calculating F&B expenses based on total hotel revenue, unless you're doing a departmental schedule. But when we get to USAR recommends that all ratios are calculated as a percentage of total sales except food costs are divided by food sales, beverage costs are divided by beverage sales. Why do we do that? This gives us our food cost percentage and our beverage cost percentage. We want to make sure that we know how much our food cost is for the food revenue, the beverage costs for the beverage revenue, because we needed the food to create the food. We didn't need the beverage costs to create the food. We really want to make sure that we are making the kitchen and the bartender staff accountable. Okay? So we're making people accountable by being able to break it down by those departments, by whoever is producing the food and whoever is producing the beverages. We want to make sure that we're making people accountable. So why complete a vertical analysis or a common size analysis? We're going to be able to compare ourselves to industry averages now once we do this. We can also compare ourselves to our budgeted performance, so what we were supposed to do and what we did. We're going to be able to use this in budgeting as well. We're going to be able to compare ourselves to other units in a corporation. So if we have many different W hotels, we can compare ourselves with common size analysis to other W hotels. We can compare these percentages from other periods. So historical information. One of the big reasons why we do this is responsibility accounting. By doing this, we can hold departmental managers responsible for the respective department. We're going to see some examples in a second of how we can do that. The last thing we want to make sure that we'll remember is that the final line, our net income at the bottom, is really referred to as our profit margin when you look at that percentage. Okay? It's one of the most telling indicators on a summary operating statement or on a USAR income statement of a manager's overall effectiveness at generating revenues and controlling costs in line with forecasted results. So by dividing our net income divided by our total sales, we found out, multiplying it by 100, we find out our profit margin. So at this point, I would like you to go to your Excel, USAR, and UCLE income statement example, and we'll perform a couple of common size analysis. So we're going to start with our USAR income statement. So as stated, we'll switch this to percentage by using the percentage key. Our total revenues will always be 100%. And they're all in dollars, so just quickly change it to percent. Okay. While you're at it, highlight the whole C column and just change it to percent, and same thing with the entire E column. You can just hit the percentage icon. So our total revenues will always be that common number, therefore they will always be the 100% that we're comparing everything else to. If I wanted to find out what the breakdown of my food revenue was as a percentage of total revenue, I would divide my 4,010,964, and I would divide it by my total revenue, $5,379,728. And that would give me, now, again, we're using Excel, so it automatically knows that I'm looking for a percent here because I changed this to a percent. If using your calculator, you have to make sure that you then go times 100, right? Not in this case because we're using Excel. But you would divide our total revenue, our food revenue, by our total revenue times 100 to get 75%. Okay? So we'll use 2 decimals whenever you're using common size, so 74.56%. What this means is that 74.56 of our total revenues are coming from food revenue. Okay? We would do the same for our liquor revenue, so $352,009 divided by our total revenues. Okay, our $5,379,728, and that's telling me that, and again, 2 decimal places, 6.54% of my liquor revenue are coming from, of my total revenue comes from liquor. I'm going to start using Excel now to make things a bit quicker, so I would divide my B10 by my total revenue. And I would do the same here, divide my wine revenue by my total revenue to find out what percentage. And I would want 2 decimal places. Okay. So far I can see that food revenue brings in the most out of my total revenue. Now if we do the same here, for this current year for 2012, I'm going to divide my $3,758,697 by my total revenue for that year. So 73%, 72.53%. I'll do the same but using Excel here. And all I'm doing is divide my beer revenue now by my total revenue, and then my wine revenue by my total revenue. And I'll just make these to have 2 decimal places. I would suggest you use your calculator as well at some points because you will need those for exams. So now if we take a look, you're 72.53, so we actually have less of a percentage of food revenues when you compare it to our total revenues. It went down a bit, but it's fairly consistent from year to year. Okay, where in 2011, liquor revenues represented 6.54% of my total revenues. In 2012, it was 6.36%. It's not that big of a change. Okay? If ever you want to make sure that you completed this section properly, you can just add these 4 items up or any of your revenues up, and you should equal 100%. Now, the big thing about USAR, as was mentioned earlier on in this presentation, is that your food costs you do not compare that to the common number total revenue. We're going to compare food costs to food revenue. So we're going to divide $994,719, and we're going to divide that by our food revenue. So that's because they're directly related. Okay? In other instances, when we get lower down in this income statement, you're going to see that we don't do this anymore. So 25% is what my food cost percentage is. 24.8. I would do the same for liquor, so I'd go $41,537 for liquor for 2011, and I would divide it by my liquor sales for 2011. Again, because I'm using Excel, it knows that I'm using percentages. Normally you would have to multiply this by 100. Okay. For beer, and this is where I'll start using Excel, I'll divide my beer cost by my beer sales, my beer revenue, and then I'll divide my wine cost by my wine sales. Okay, we would do the same here. So I divide my food costs by my food revenue. This is, think back to your costing triangle. I would then divide my liquor costs compared to my liquor revenue, my beer costs compared to my beer revenue, and my wine costs divided by my wine revenue. And added a couple of decimal places. So if we take a look, last year, or in 2011, food cost was 24.8%. This year it's 25%. Very consistent. Liquor cost last year was 11.8%, and this year, I keep on saying that, but 2011 compared to 2012, fairly consistent, and same thing here. So our costs, while our costs may have lowered, okay, so if you take a look, we actually went down in costs. It's still the same food cost percentage because our food sales went down as well. So we're keeping our costs in line is what this means. Okay, because as we have more sales, we should be having higher food costs in dollars, but this percentage, we want it to stay fairly consistent, okay, or below industry averages or at industry averages. So all this means is that our food cost percent is consistent. Even though it looks like we went down in food costs in dollars, we did, but we also had less revenue. Okay? Now when we get to total cost of sales, this is when we go back to dividing our number by our total revenue. So we would divide our total cost of sales by our total revenue. 25%, but really 24.74. And then we would go our total cost of sales by our total revenue. So our total cost of sales is slightly higher in 2012 than 2011. So total cost of sales in 2012 represented 24.74% of total revenue. In 2012, it's 25.15% of total revenue. Okay, and that's how we read that. That's how you would understand that. Now for the rest, we're going to always compare it to total revenue now. It will not change. So divide service by total revenue. Okay, I think you get the point where we are always going to compare it to our total revenue. Using Excel, I'm just going to divide it by total revenue and then use something that you'll learn in one of your classes to make sure that I can just click and drag. Okay, and then I will delete any zeros. And there you go. I'll do the same here, where I'm just doing this just the quickest way using Excel, but you can go through every step yourself and confirm these numbers using this presentation. And now we have, and I'll switch this to 2 decimal places. Now we have our common size analysis for both years. So again, we're comparing everything, all of these finance lines, all these expense lines to total revenue. The only ones that we don't compare to total revenues are our cost of sales here. Not our total cost of sales, but just the other cost of sales. So our food expense is compared to our food revenue. Food expense from 2012 is compared to food revenue from 2012. Liquor to liquor, beer to beer, wine to wine. Okay? The rest though, like I said, is compared only to total revenue and always to total revenue. So if we take a look down, we can start to compare from year to year what happened as far as the common size analysis. Our controllable income, okay, is actually lower in our 2011. Now, the reason why that might be is our prime costs were higher. So if we take a look at our labor as a percentage of total revenue was higher in 2011 compared to 2012. So it was 52.62% of our revenue was taken up by our labor expenses. How you would read that. That's in 2011. In 2012, it was pretty much 50%. So we actually brought down our labor expense. If we take a look, our service went from 15.64% to 14.99%. Our production went down. We saved 1 point there. We brought it down from 15.22 to 14.2. And same thing with our payroll taxes and benefits. So what this means is that we controlled our labor much better this year. Management stays the same. Okay, so but we brought down our labor costs. Those are controllable costs, which then means that our prime costs, our labor and our cost of sales together is actually lower. See how it's such a big chunk of our total revenues for a restaurant. That's why they're referred to as prime costs. We control them and they represent a big portion. So our prime costs actually took up more of our expenses in 2011 than 2012. So while we made less money, we're controlling our costs in a more effective manner. Doesn't look like there's much of a difference from 2011 to 2012 for the rest of these direct expenses. Okay. So yeah, last year they were 5.49% of total revenue. This year they're 5.59%. Very similar. While they were lower, notice that it's actually a higher percentage of total revenue because we had less revenue. Our controllable income. So while we may, we're actually lower, okay, from year to year in dollars. If you take a look, our controllable income is 17.15% of total revenues, and in 2012 it's higher. So we're doing better as a percentage. And then finally we can take a look at the rest. It'll tell you that our total non-controllable expenses were almost the same as a percentage of total revenue, all the way down to our profit margin. Okay, so that's our income compared to our revenues. So overall, our profit margin was 9.47% in 2011, but our profit margin for 2012 was higher, so 11.49%. I'd be happy with that as a manager. So while our revenues were lower, we actually had a higher profit margin from one year to the next. So that would be for a USAR. Now for our USALI departmental schedule, we're comparing our rooms revenue for this department to our total rooms revenue. Okay. So again, just remember that you can multiply it by 100 to make it a percentage, but because we're in Excel, we'll just hit the percentage button and add 2 decimal places. Zoom in a bit. Our room revenue, guest groups room revenue, we would then divide that by our total rooms revenue. And again, I'll use some Excel magic and just do this. I would do the same for 2012, where I'm dividing my rooms revenue by my total rooms revenue for this example. Okay, this would be 100% because we are comparing always to the rooms revenue. This is the total revenue for this statement. So in this case, I could take a look at, for the rooms department schedule, what my breakdown is. So in 2011, I had 85.66% of my rooms revenue came from transient. Well, it stayed the same the year after. While I dipped down a lot in revenues, and it looks like, if you just looked at it, it looked like $1 million coming down from transit rooms revenue. That's the problem, because it looks like such a big number. But when you look at it as a percentage of rooms revenue, it's actually pretty much the same amount of revenues when you're comparing it to total revenues. So while we may have gone down in total rooms revenue, and it looks like transit was the most important one, all of them as a percentage of total rooms revenue kind of stayed the same. Okay. We would then complete the same operation we did with our USAR income statement, and now we're going to compare everything to our total rooms revenue. Now again, I'm going to just complete some Excel magic so that we don't spend too much time in this video. But I would find out what my front office and uniform staff is as a percentage of total rooms revenue. I would do that for housekeeping compared to total rooms revenue, so on and so forth. Okay, and then I would perform the same for for 2012, turn those into percentages. So if we take a look at 2012, we had less revenue, yet now we had less, front office and uniform staff expense as far as our payroll goes. It went down, but if you take a look as a percentage of revenue, it actually went up. So my labor costs for front office was 8.0%, 6%, and in 2011 when I had this much revenue. This year, it's 12.44%. This number should have gone down even more, okay? Because if I was able to run at 8% labor cost when I had more revenue, I shouldn't have this high percentage. Housekeeping would then compare these two. Again, housekeeping is too high, and overall our total payroll as a percentage, while it seems like it's lower, it's not low enough as a percentage. Okay, just if you take a look at the dollar amount, sure, we went down by 28,000, but we should have gone down by a lot more because our labor cost percentage is 26.23 of rooms revenue. As a manager, I would look at this and be very concerned. For your other expenses, they stay the same as a percentage of total revenue, pretty close, so I'm not concerned there. My total expenses though, because of that payroll, as a percentage of total revenue, my total expenses went up quite a bit, okay? Which means that my income went down as a percentage of total rooms revenue. So that's how you would analyze that. Now for this summary operating statement, we would complete the same thing, okay, the same approach. So we would complete our rooms revenue compared to total revenue, rooms expense compared to operating revenue, so on and so forth, okay? Everything would be compared to our total operating revenue. Every single line going down all the way to the bottom. And then we would compare our percentages from 2012 to 2011. We would do the same for the statement of income. It would always be compared to total revenue. See if you can complete this and bring it to class completed for your summary operating statement and statement of income.